From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro. When does something break? We're not seeing it in the equity markets. They are down, but it is not violent. However, in the bond market, yields climbing to decade highs. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
We begin with the big issue. Treasury yields just keep on surging.
These yields are not all overdone, at least not yet.
The story of this year has clearly been higher bond yields.
The rising bond yields.
We're back to a different era, and I think that we will stay here.
It really comes down to inflation.
We keep going back to inflation data.
We're probably going to see persistent inflation.
And that keeps yields still a bit on the upside.
U.S. data is not going to provide much leeway for yields to fall.
The underpinnings of the economy here in the U.S. is really quite robust.
The reality is that hard activity data are still pretty strong.
What that means to me ultimately is that the Fed has to do more to slow down the demand side.
The two-year yield always peaks above whatever the terminal rate is.
We still got about 75 basis points more to discount.
For a bond investor, it's all going to be about rates.
It is all about yields right now, 4.3% on a 10-year yield in the United States. As we were talking, Gregory Staples of DWS and Stephanie Roth of JP Morgan, we've been talking about could they get up to 3.5% a couple of months ago, even a month ago. And yet here we are. Gregory, what do you make of the move that we're seeing today?
You know what? I think what's been going on is that the markets really had a sea change in their perception of what the Fed's going to do. If you go back to the summertime, there was real skepticism and a sense that a pivot was going to come fairly soon. And the Fed speakers pushed back against that fairly hard. And now the markets embrace the tightening with an almost evangelical passion. The market's almost ahead of the Fed now, pricing in 5% by the first quarter of next year. And you're seeing that reflected across the curve. And now for the first time, it's really starting to impact the long end. Are we close to the end? I don't know, but boy, oh boy, we've come a long way in a very short period of time.
Stephanie, what's your view here, especially as we see the pace of the move this morning? We've retraced from some of the highs, but still at the highest levels in the 10-year Treasury going back to 2007.
Totally agree with Greg in that it was driven initially by the economy holding up better than expected, inflation remaining higher. But more recently, the move seems to be less fundamentally driven. It appears to be more about illiquidity. And that could mean that the 10-year could back up even higher than where we are today. But we do think eventually rates should rally. And we do think that on the back of recession fears and recession actually playing out in the middle of 2023, rates should rally. It's just a question of how high does the 10-year get before that happens.
Well, and this to me really goes to the question that a lot of people are asking, Stephanie. Bank of America's Mark Cabana warning of Treasury market dysfunction, exactly kind of what you're referencing, writing, quote, U.S. Treasury liquidity has deteriorated amid weak demand and investor risk aversion. The market is fragile and vulnerable to shock. A Treasury breakdown is not our base case, but it is a building tail risk. Stephanie, as you put it, is it a tail risk or is it actually a tailwind potentially giving to a rally with some sort of, I don't want to say pivot, but a sense that this cannot go on forever?
Totally can't go on forever. That said, the Fed's not likely to step in at this point, so this could get worse before it gets better. Eventually, we would expect that the Fed would step in the event of it becoming dysfunctional, but we're not at a dysfunctional point at this juncture. So it could continue for some time before the markets settle down.
Gregory, from your perspective, Stephanie was talking about how it feels very technical in nature. Do you have a sense, based on your on-the-ground view, of who is doing the selling, of where this is coming from, why the buyers are not stepping in?
I'm not so sure it's the selling. I think it's the removal of the buyers from the marketplace. The three big buyers have really stepped away from the market. Of course, the Fed, number one, is they've pivoted into QT. That's $95 billion of buying that's disappeared every single month. The banking sector, which was a huge buyer, they had to invest the reserves that the Fed was creating through their QE program. They've pulled away, and you've got a lot of really sort of frozen longs who have mark-to-market positions well below par, and they really can't sell those without realizing some accounting losses. And finally, overseas buyers have stepped away. If you look at Bank of Japan, Bank of China, et cetera, they were big takers down of treasuries, if you will, for an extended period of time. they've pulled back. So I think it's really an erosion of demand rather than it is sellers on the supply side.
It's hard to game out the bond market for sure, and a lot of equity analysts are trying to understand what this means for valuations over the long term if we can't get a sense of whether we do get some sort of violent reversal in yields back down towards something that we've seen that's more familiar over the past few decades. Stephanie, from your perspective, have we seen the re-rating of valuations within the equity space on the heels of some of the yield market move, or do you think that that has more to go?
There may be some more to go, but we do think with equities trading close to 3,600, that's the time to start stepping in. We'd be buying on that dip. Yeah, it could get worse before it gets better, especially as the market starts to price in the recession that's likely to happen. But at this point, we would be adding to equities. We'd be buying industrials. We'd be buying technology at reasonable price. We'd be buying healthcare. So now is as good a time as any, both for the 60 and 40 side of your portfolio. All
right. Well, we're going to be digging into that in the upcoming hour. We are looking at earnings as they've been coming out. We are more than 20% done. Earnings starting to sour with corporate America struggling to clear a low bar, at least in certain pockets. Share prices getting punished and disappointing results definitely are being making their mark. Right now, let's go to Bloomberg's Katie Greifeld for more. Katie.
Well, Lisa, you're right. Earnings season definitely ramping up, and it's not going great, I would say. You have hospital stocks under pressure this morning. That's after disappointing results from HCA Holdings and from Tenet Healthcare. Tenet down a whopping 22% after revenue guidance was narrowed. You also have Whirlpool and American Express under pressure as well. And this morning's price action fairly emblematic of this earnings season so far. You have expectations, like you said, they've been lowered dramatically, and companies are still managing to disappoint. You're looking at estimates now versus 3 months ago. S&P 500 third quarter EPS growth, it's currently expected at 2.2% for the third quarter. That figure was 6.3% on July 29th. Feels like a long time ago. And it's early still, but so far this quarter on track to be the most punishing for companies that miss estimates since at least 2017. That's as far back as our data go. The average one-day change for earnings misses is a 3.8% drop. But Lisa, we've got another big week next week, so we'll see how that goes.
Katie Greifeld, thank you so much. Chris Harvey of Wells Fargo reshuffling the portfolio in response to some of these earnings, but not necessarily the way you would think. You ditched just cyclicals and downgraded the big banks. Take a listen.
It's more of a macro issue than anything else. And if you look at how banks report and look at the numbers, they popped, they're performing in line with the market. And we thought this was a good time just to step off this trade. Nothing that we really don't like about the banks, but we do think it's just more of a market perform as we think about things too. Sentiment or the macro sentiment's going to be an overhang, and we just don't want to fight that.
Stephanie Roth and Gregory Staples still with us. Stephanie, from your vantage point, how much is this really the story of this earnings season that people are using, whether stocks rally or whether stocks sell off, as just a way to double down on their theses, regardless of what the earnings actually showed?
I think it's actually a function of margins remaining elevated. That sounds like a good thing from a stock perspective, but from a macro standpoint, we don't really want margins to remain high. That's challenging the Fed even more. That means the Fed has to go even higher to get the slowdown in the economy. If margins don't roll over, that won't allow the labor market to cool down. Why would companies start doing layoffs or really pause hiring if their margins remain elevated? So the fact that earnings remain pretty decent at this point is not actually a great thing for the long-term picture. That means the Fed's going to go higher, and it could result in a larger downturn than would otherwise be the case.
And Gregory, this is the reason why there have been such confusing signals right now from the credit markets. We've seen in investment grade, the sell-off has been really marked and much more dire than what we've seen in high yield, even though high yield, arguably more leveraged companies heading into a downturn, would have a difficult time. What do you make of that, this resilience in high yield at a time when investment grade is really seeing the biggest losses?
I think there's a couple of good reasons there. First off, I think a lot of the corporations used the last 2 years to really pre-fund a lot of the debt on their balance sheet. And they learned resiliency from the COVID lockdown. So corporations, I think, are a lot stronger. They didn't extend themselves in terms of debt. Clearly, a lot of the high yield market is in the energy and raw material space, which has done fairly well overall. You know, we have not seen the kind of widening in terms of spreads that you would see if you're seeing an economy enter a recession, whether that be an investment grade or high yield overall. You have to be a little bit concerned if you've got refunding coming up. The refunding markets are not closed, but they're close to. It's getting harder and harder to get deals done. So I think for the moment, we're just looking at the fourth quarter slowdown if potentially it happens. But as earnings come in the third quarter, this is not an economy that's in a recession at all.
So based on that, Gregory, are you buying the riskier securities, even though they haven't sold off as much, simply because the resilience really has been the story in so many sectors?
We're not buying them at all. We think there's probably actually some weakness that's coming ahead. The market hasn't recognized that yet. So we're actually moving up in quality and being a little bit more conservative, keeping cash balances, shorter maturities. We think that there's more potential widening to go in the fourth quarter.
And right now we are looking out also at tech earnings, which we're going to be getting into next week. How much, Stephanie, and we're going to dig into that more in the upcoming segments, but from your vantage point, how pivotal will that be to sort of set the tone about the re-rating and the fundamentals at a time when you actually see value here?
That will be important, but it's not exactly the story for the broad economy. So markets will certainly care, but when I'm thinking about the message for the rest of the economy, tech has been a bit of a divergent sector from the rest of the economy. It was benefiting from COVID. You're starting to see layoffs there, but that's not indicative of what we're seeing in the broader market. So certainly the equity market will be paying attention to it from a macro perspective. I'll be focused on some of the more cyclically inclined names.
So far, Stephanie, when you look at the ones that matter, the names that matter for an economic perspective, what do you hone in on? What sort of stands out to you so far in the earnings season?
So far, the message from the banks have been that the consumer is okay. And that's been sort of the trend that we've seen for the bulk of this year. Consumer spending has remained stable, maybe not strong, but it hasn't cracked on the back of Fed hiking. We expect that eventually it will. The housing market is certainly feeling the pain, but it takes time for it to filter into the rest of the economy. And we would expect to hear the message from company earnings, certainly from the banks, and then looking to hear what the consumer companies are saying.
Stephanie Roth, Gregory Staples, both of you are sticking with us. We want to take a look right now at the stocks moving ahead of the opening bell. With that is Kaylee Lyons. Kaylee.
Well, Lisa, the big one this morning is Snap. Absolutely brutal, plunging the better part of 30% early hours after reporting the worst revenue growth, the slowest revenue growth on record after the bell yesterday. The company blaming a continued slowdown in the advertising market because as the economy slows down, apparently a lot of companies don't want to spend as much on ads. So that's taking Snap down and a lot of other social media advertising reliant companies down with it. You could argue Twitter falls into that basket, but what's happening there has more to do with Elon Musk today. First, you had the Washington Post report yesterday saying that if he does indeed succeed in taking over the company, he could cut up to 75% of the workforce, but it's an if he succeeds because Bloomberg also reporting that the Biden administration is looking at a potential national security review of Musk's ventures. The White House says it's not aware of that, so we are off of session lows, but still Twitter down about 5% in early hours and Tesla, for its part, down about 1%. Finally, I threw Spotify on here as well. Lisa, I don't think you're a Swiftie. I would guess not. But Taylor Swift's new album dropped at midnight, in case you weren't aware. And at the same time, Spotify was running into a lot of issues with users not being able to access it. So a lot of Swifties may be upset about that. Spotify down about 1.3% before the bell.
Kaylee, thank you with the Swiftie report. Coming up, Liz Truss leaves Downing Street.
I am a fighter and not a quitter. I am resigning as leader of the Conservative Party.
The turmoil ahead and who takes the helm next. That conversation still ahead. From New York, we are seeing equities lower, although actually they have flipped with 15 minutes to go. Basically unchanged here as we head toward that bell. This is Bloomberg.
I have a bold plan to grow the economy through tax cuts and reform. It was becoming a distraction, so that's why we immediately changed that policy. We will keep an iron grip on the nation's finances. Mr. Speaker, I think the last thing we need is a general election. I am a fighter and not a quitter. I recognise, though, given the situation, I cannot deliver the mandate on which I was elected by the Conservative Party. I am resigning as leader of the Conservative Party.
A really rough 44 days for Liz Truss. The UK hoping to curb recent turmoil with a new prime minister. Markets remaining on edge with gilts heading for the biggest weekly surge on record. This coming as currency traders brace for for a possible intervention with the Japanese yen on track for 10 straight weekly losses. This is sort of the dueling stories of a strong dollar on the other side. Our team coverage starts right now. Tom McKenzie at Abingdon Green and Kaylee Lyons here in New York. Tom, starting with you, can you give us a sense of how much the markets are truly in control in the United Kingdom, even as they search for a new prime minister?
Well, the markets have put the parameters, they put the guardrails around this race for the next Prime Minister, because it is made abundantly clear to the Tory membership, the Tory party, of course, the leading governing party, and everyone here in the UK, frankly, that you need to have sensible financial and fiscal policy. The markets will punish you if you don't stick to the orthodoxy. Behind me in the Houses of Parliament, you do have that fierce lobbying now behind the scenes, a kind of mercurial atmosphere as the numbers start to add up. So the context is that you are likely to get 3 candidates who will be put their names to a ballot on Monday around 9 a.m. US time. They have to have at least the backing of 100 MPs each. There's 357 members of the Tory party, so that leaves 3 candidates. Currently, the numbers coming through, according to the Bloomberg number crunches, is 52 for Rishi Sunak, the former Chancellor of the Exchequer, 52 MPs backing him, so he's more than halfway through. 28 for Boris Johnson, the former Prime Minister as well, in what would be a remarkable turn of events. This is a man, of course, who's cut his holiday short in the Caribbean to fly back to the UK to gauge the opportunity as to whether or not he throws his hat in the ring. And then there's the former Defence Secretary, Penny Mordaunt. She's currently got 16 MPs backing her. So that is the process. You get to Monday, it will get whittled down in that ballot of members of the Conservative Party to 2. It is likely that the follow-up will, the second person within that run-up will probably be pressured by members of the Parliamentary Party to step down. If they don't, it goes to a vote from members of the party outside of Parliament. The deadline is Friday the 28th. That's when, at the very latest, they'll have to have chosen a new Prime Minister. But it could come as soon as Monday. You talked about the markets. Yes, today yields up, the pound down. But broadly, as you mentioned, yields have come off this week. Bonds and gilts have been bid. A crucial timeline for markets and investors is that fiscal plan that the current Chancellor says will be outlined on October the 31st. Question marks as to whether or not that deadline will be kept. And that is crucial for markets.
It seems like Jeremy Hunt has provided the ballast for markets that they were looking for. Kaylee Lyons, we're looking around the world, and very much this is all the counter story of the strong dollar and yields going higher with the Federal Reserve hiking. It isn't just the United Kingdom that's being forced to respond. It's also questions about how Japan does, given that the yen right now is weakening dramatically to the lowest levels that we've seen going back to 1990.
Yeah, since June 1990, it's absolutely brutal. It has been brutal for everything in G10 up against the dollar this year, but far and away it has been the worst for the Japanese yen. It has weakened nearly 32% against the dollar on a year-to-date basis. We are north of 151, so that raises the intervention question, because remember, we already saw it last month, and that was when we were at a 146 handle. Clearly, we've gone north since then, so that intervention wasn't necessarily effective. There's 2 things to consider here. One being that intervention rarely works when it's only one player in the game. You kind of need collective action. Japan did not have that. The other being there is still the rate differential problem in that every other central bank, most notably the Federal Reserve, is aggressively hiking interest rates. Japan and Kuroda at the BOJ are doing no such thing. So as we have seen yields moving literally hundreds of basis points in the UK, in the US, in Germany, we have gone 18 basis points on the 10-year JGB yield on a year-to-date basis. Why? Because it's capped at 25 basis points. Traders, though, are starting to test the Bank of Japan on that yield curve control. And a great chart here from our very own Valerie Teitel points out the hedging we are seeing for a break in the BOJ's curve control. Look at the swaps market, the 10-year yen swap at 65 basis points. That is 40 basis points north of the BOJ's target. So clearly, Lisa, the market here is saying something's got to give. Intervention in and of itself might not be enough.
And thank you so much, Tom McKenzie and Kaylee Lyons. This really speaks to what we were addressing with Gregory Staples and Stephanie Roth, who are still with us, about what happens when something breaks. Gregory, as you take a look at some of the FX moves, how much is that what's going to break first? Are some of these moves, particularly in Japan, unsustainable?
I think ultimately it is. I mean, obviously, if you go back to your macroeconomics in college, the Bank of Japan can do one of 2 things. They can control interest rates, which they're trying to do through yield curve control, or they can control their currency, but they can't do both. As long as they're generating an unlimited supply of yen through purchases of JGBs in the marketplace to control that 10-year rate at 25 basis points, it's going to flood the market with supply of yen, and they can't control the price. probably won't change until Kuroda's term is over in the first quarter of 2023. But until then, it's going to be quite volatile, and I think continued upward pressure intervention is not going to change it.
Stephanie Roth, a final word on this issue.
We think that something is going to break, and we all spent the last couple of weeks learning about UK pension funds. That wasn't the thing that broke the market. But in this type of environment, something likely cracks, and we don't know exactly what it might be, but we're watching closely, and eventually central banks will have to step in.
And is there some sort of read-through with the Japanese yen and U.S. equities? I mean, is that something that you are parsing out?
I would say, it's surprising how well U.S. equities have held in, given what's going on in the backdrop. We think that a lot of the pain is in the price there. And certainly equities would rally if we do get some intervention from central banks. So we're watching that closely for sure.
My thanks to both of you. Stephanie Roth and Gregory Staples. Have a wonderful weekend on this Friday morning. Coming up, the morning calls, and later, bonds are back. That's the view of Amundi's Monica Defend. Seeing some stabilization in the bond market. Monica joining us around the opening bell here as we have a tumultuous session just moments away. This is Bloomberg. Flipping between gains and losses with 5 minutes to go. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. We are now in the loss segment of this morning's flip-flopping. NASDAQ down 0.4%. The S&P down by just about 0.1%, really driven by the yield story. Yields have been much higher. They have been coming off some of those recent highs. Taking a look at that 10-year, 4.33 at 1%, now down to 4.29%. The 2-year yield at 4.5%. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Raymond James downgrading Lennar along with other home builders within their coverage, highlighting a stalling housing market and a lack of visible catalysts. Next up, Telsey Advisory downgrading Under Armour to market perform, $8 price target. Expecting earnings to fall short following disappointing results from Nike and Adidas. And finally, Bank of America downgrading Snap to neutral, cutting the stock's price target in half after reporting its slowest quarterly sales growth on record. Coming up, Snap fielding an exodus out of social media stocks ahead of a busy week of tech earnings. That conversation coming up next. The opening bell just around the corner. This is Bloomberg. This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro. Just moments away from the start of trading. NASDAQ lower by 0.5%. S&P fluctuating between gains and losses. The story has been the yield story, which have paired some of their advance. You had seen at one point 4.33% on the 10-year yield, now down below 4.3%, but really driving the action with this feeling of dollar dominance and yields ever higher. You are seeing that 10-year yield off the highs. The euro dollar is still seeing that weakness in the euro. Dollar strength 97.68, and you could see the yen climbing at one point very close, bumping up against 152 with the dollar stronger versus the yen. Joining us now with a look at the stocks moving ahead of the opening or at the opening bell. Here's Katie Greifeld. Katie.
Lisa, I have to start with Snap because it posted the slowest quarterly sales growth ever. You had advertising spending just absolutely in the gutter, a potential warning sign for other social media companies, but all the action in Snap this morning down about 27%. American Express, too, under pressure. It's still seeing good spending, but that strong dollar eating into guidance. And Amex, it set aside more for bad loans than analysts had expected. Shares off about 3% or so. But let's get to some good news. We're going to do that with CSX. Shares higher after the railroad operator beat estimates. Profit was up 21% year over year. The company also reiterated its full year guidance. Shares higher almost 3%. And Schlumberger posted its highest profit in 7 years, largely thanks to a big overseas pickup. You have drillers putting oil and gas rigs back to work. The company also said that sales and margins should expand in the fourth quarter.
Katie, thank you so much. Earnings season very much underway. Separating the haves from the have-nots. Bloomberg's Kaylee Lyons joining us now with the scoreboard. Kaylee.
Well, the scoreboard actually looks relatively decent, Lisa. When you look at the S&P on average, about a fifth of the way through earnings season, we are seeing earnings down about 1.7%, but the majority of companies are topping expectations, and that includes a lot of those that have seen the most reports already. We have seen about half of the financial sector reporting. 75% of those names have topped expectations. For staples, industrials, communications, all between 20 and 30% of the sector has reported, and we've seen very decent beats there as well. So a lot of those companies are getting rewarded. In the communication sector, for example, Netflix is one of the big ones that saw a nice post-earnings boost of about 13%. We've seen a nice lift for Lam Research, AT&T as well. But when you miss, you do indeed get punished. Union Pacific off 7% the day after its report. Comerica by 9%. M&T, those regional banks, getting hit pretty heavily. It was down about 14%. So as for how that translates onto a sector basis, in the last week, we have seen media and entertainment doing fairly well, as well as the airlines. They are still raking it in. A lot of people want to travel, even though fares are very, very high right now. The airlines index up about 2.7% on the week, but elsewhere in transports, it's a very different story. Look at the trucks. The trucking industry and the railroads, transportation down about 1%, and consumer durables as well, about 1.2% on the week, Lisa.
Kaylee, thank you so much. Social media stocks very much under pressure. That Snap decline, the biggest going back a long time, the most since July, just tremendous. It has paired some of those losses coming ahead of a monster week of earnings. Meta and Google on deck. Bloomberg's Ed Ludlow joining us now for more.
Yeah, this was a stock that in November was trading above $70 a share. How things have changed. We're now much lower than that, below $8 a share. One of the big questions is all of the issues that Snap outlined, a pullback in budgets among a broad range of advertisers, macro headwinds, the impact of inflation on the consumer. How much of this is transitory, Lisa? How much of it is specific to Snap? And most importantly of all, as we get into the meat of this earnings season, how much does this spread to other names? We have an incredibly tough week coming up next week with the likes of Meta, the likes of Twitter, although there's slightly artificial trading around that subject to the purchase by Elon Musk. What are they experiencing with the ad market here? And what do we read into this situation as a lens into the health of the consumer? You also have a slightly different take, of course, through Alphabet, the parent company of Google. You and I discussed this earlier. We went into this with a mixed opinion about technology. Potentially, the third quarter could have seen EPS hold up better in certain corners of the technology market. My goodness, are the list of problems and headwinds growing. I'm still excited, though.
Ed Ludlow, thank you so much. I'm excited, too. I think it'll be helpful to see exactly where things are at. Yields, meanwhile, continuing to soar higher and hitting pause on the latest equity rally. Investors wondering, is the honeymoon already over?
This is a very impatient market.
You don't want to get too comfortable.
It's way too early to say capitulation. I mean, I think that's heroic.
The Fed just started raising rates this March.
We have not seen the real impact of tighter financial conditions.
That means bumpiness in the market.
We've seen the market sell off a lot.
Investors seemingly have no tolerance for pain.
That potential capitulation. There's still work to be done.
We're going to get these bear market rallies.
The bear market rally, it's short, it's sharp.
Companies are battening down the hatches and getting ready for choppier times.
Before we can say this bear market's over.
We need to see some of that weakness coming through.
We're going to be on this roller coaster to nowhere.
The roller coaster to nowhere that we're all on. Amundi's Monica Defend joins us also on that roller coaster to nowhere. Based on the roller coaster of yields ever upward, at least so far, how much have equities fully priced that in?
Well, we don't think that equity actually ever really priced in a prolonged recession. But if you ask me what are our working assumptions, we do frame the current outlook within an environment of earnings recession for this year and prolonged for longer higher inflation. And this is obviously reflecting into the equity path because the central banks on the other side, they remain quite hawkish. So let's see how much and what the terminal rate for the Fed, for example, will be. We stay between 4.75–5%. But this is what is really concerning investors amid earnings that are running under margin compressions and cash flows that have been reducing so far.
Right now, really the news of the morning has been in the yield space, with yields climbing to the highest level in the U.S. going back to 2007. Real yields also climbing to the highest levels that we've seen going back to 2009. And then there was a bit of a retracement after a Wall Street Journal article came out written by someone known as the Fed Whisperer, talking about how Fed officials are looking for a 75 basis point rate hike at their November 2nd decision. And then after that, more voices saying to pause. And how much, Monica, is that really a deciding factor for you in terms of how high yields can go, whether those naysayers on a Federal Reserve can really get their way and cause some sort of think, pause, wait for that lag time to take effect?
Well, we're pretty convinced that November and December we'll see no-kish Fed. So we are penciling in a 75 hike each. Then when we move into January and February, we'll see, but we do believe they will continue to hike. And it is unlikely that they will pause, because it's their credibility that is at stake. So, and this was really, really clear to us last week at the time we've been joining the IMF meetings. If you look at the textbook Taylor rule, 6% terminal rate is what theoretically might help the Fed to go back to target in 2024. But in order to get there, the price that we are gonna pay in terms of earnings, margin compression, higher yields, and economic recession is definitely non-negligible.
Wait, 6% terminal rate, is that plausible to you?
I think that they will stop earlier, just because it is true that Powell at Jackson Hole said there will be pain to come. We really need to be focused on inflation, but such an increase, such a fast increase of rates might be detrimental at some point to fiscal stability. So as of today, hard data remain quite good. But we are seeing some cracking in the soft data if you look at the confidence indicator. And I don't think that really they can ignore all these kind of costs when it goes to fast increase of rates.
Well, perhaps they can't get to 6%, but the team over at BNP Paribas expects rates to rise past 5%, writing, quote, "We now expect a terminal Fed funds rate of 5.25%, thereby lifting policy rates to a sufficiently restrictive stance to cause recession. The recession is likely to start around Q2 2023 and endure for 3 to 5 quarters." Monica, from your perspective, how much does that really make the argument for cash, for remaining nimble, for not being overly invested as the markets catch up with a view that is increasingly higher yields and a Fed that has to do more?
First, I agree with the fact that if we move into 6, we might have a prolonged recession that might last several quarters going into 2024, even before you see inflation cooling down. Having said that, it is really important to look at how the economic partner will evolve, and cash is a decent hedge, if you want, vis-a-vis this margin compression that honestly, spread compression that honestly, when we look at spread, they've not been moving that much. And this is kind of weird, no? Because it means either the corporate sector is quite safe, and we do believe that they might have some solvency issue moving forward. But the resilience of the credit space, to me, has been really surprising.
Yeah, well, I agree. I mean, not that it's been surprising overall, but that in particular the high yield space has underperformed in an environment where people would say, well, typically the more leveraged companies would get beaten up the worst. How do you explain this? I mean, do you think that we are entering a credit cycle that people are unprepared for, or do you think this highlights the resilience of balance sheets that have really gotten flush with cash and pushed out maturities?
I think that there might be some cases of resilience where the balance sheet might really be being reduced. But honestly, we've been getting even more selective over time on the high yield. And in general, we do prefer investment grade to high yield. So maybe he's more on the investors' irrational. This credit resilience so far.
What's your sense about whether there are any spots within the equity space to hide, or if this is really, at this point, something that needs to be parked on the sidelines?
Yeah, definitely. Well, from a regional perspective, we think that the U.S. economy is still in a better shape when compared to Europe, and this is justify our preference for U.S. equities versus Europe. Then if you look at our sector allocation within Europe, staples, industrials, IT and utilities offer some nice opportunity. When it goes to the U.S., also the banks in the U.S. seems to be extremely resilient, and the healthcare sector as well. On the emerging market, we've been moving to the cautious side. We've been reducing also the exposure to China, which remains a really big question mark on what's next. We do believe that still the rebalancing has to take place in China, so further has to join the economy.
Monica Defend, you'll be sticking with us. Coming up, Musk's Twitter deal facing yet another headwind, this time from the U.S. government.
I'm wondering how much Elon Musk is regretting this impulsive decision to buy Twitter. It's been a huge distraction. It's definitely affected the Tesla stock.
That conversation coming up right now, just 15 or 13 minutes into the session, and you are seeing the whippy action turn to losses. The S&P down 0.4%. This is Bloomberg.
There's been so many rumors about this Twitter deal. We don't know what is true and what isn't. And also, I'm wondering how much Elon Musk is regretting this impulsive decision to buy Twitter. It's been a huge distraction. It's definitely affected the Tesla stock.
There have been a lot of sagas, and this has been yet another one of them in the Twitter story. Bloomberg reporting that the Biden administration is weighing security reviews of Elon Musk's ventures, including his bid to buy Twitter. And of course, the department did come out and raise some questions about that after that report came out. Bloomberg's Ed Ludlow back to make sense of all of this. Ed, please help us.
Yeah, good morning, Lisa. There were 4 key reports on Thursday night, all about Elon Musk, all about Twitter. The first, as you said, according to Bloomberg sources, various individuals across various agencies in D.C. are looking at security reviews of Elon Musk and Elon Musk's businesses. This stems from his comments around the war in Ukraine, his comments around SpaceX's support for the use of Starlink in Ukraine, and of course, his purchase of Twitter. As you said, this morning, the White House has said it is not aware of any national security review of Musk Ventures in response to that Bloomberg report. The Washington Post reported that Musk is telling potential equity partners in this Twitter deal that he will cut the workforce by 75%. Bloomberg has confirmed that he is telling investors that. Twitter, in a memo sent to his staff, which sources shared with me, say there is no plan for company-wide layoffs. There were talks ahead of the merger agreement being signed in April about cost-cutting measures, but once the agreement was signed, those talks end, no plan for company-wide layoffs. And most importantly of all, in the background, Bloomberg News reporting, according to sources, bankers and advisors on both sides of this deal are getting on with it. They fully expect to have a document in place and for the merger to close by the October 28th deadline put in place by the Delaware judge, 5 p.m. on that date. We're also reporting, according to one source, that key banks are just waiting for any day now Elon Musk to call in that debt financing, and there's no expectation that the banks will hesitate in providing that $12.5 billion of debt financing. Those are the stories.
Perhaps because they haven't found the loophole yet in the contract. I have no doubt that they're looking for it. Ed Ludlow, thank you so much. Twitter not the only deal under the White House microscope. For more, Bloomberg's Joe Matthew joins us with other companies facing some regulatory scrutiny. Joe.
Yeah, we moved to high tech in this case, Lisa. It's interesting, the conversation we were having just a couple of weeks ago about the United States cracking down on exports of high-end semiconductors, chips used for artificial intelligence and supercomputing. We add another layer here with Bloomberg reporting that the administration is now considering clamping down in a very similar way on AI software and technology that surrounds quantum computing. This is very high-end technology that kind of moves beyond the ones and zeros that could really change the shape of high tech in the future here. And the United States does not want China to get its hands on this in what is now really looking a lot like an economic Cold War. In terms of the companies here, it is that, by the way, moving stocks without any official announcement here. These are just reports and early planning here. But Nora Technology, Chinese tech firms like ACM Research and Piotech are trading lower, Lisa, as long as we're also seeing some U.S. tech companies developing this technology trading lower today as well. Think Microsoft, Intel, and IBM. But it's not just tech that could take a hit from regulators here in Washington, as we learn now that two high-ranking senators on the Judiciary Committee, Senator Amy Klobuchar, a Democrat, and Republican Mike Lee, are calling for a hearing now in the Albertsons takeover, or at least proposed a takeover of Albertsons by Kroger. This is the big grocery merger that's been in the works here. We knew this deal would face scrutiny. Klobuchar and Lee, top officials again on Judiciary, say they have serious concerns about the deal. Antitrust concerns Klobuchar is pointing as well in a letter now to the FTC, which still seems to regret approving Albertsons' takeover of Safeway a couple of years ago that resulted in a bankruptcy and some spinoffs here. So I would expect a lot more conversation about this following the midterms that will begin with a hearing on Capitol Hill and will likely trickle to the FTC, Lisa.
Great work, Joe Matthew. And I'm just looking right now at Albertsons shares down more than 24% in early trading, perhaps in the heels of some of the pushback that was, as Joe said, expected because of the big antitrust push by this administration. Amundi's Monica Defend is back with us. Monica, we haven't really talked about the potential policy risk because there is a feeling that markets are in charge. Do you think that that is true, or do you think that there is a policy risk that perhaps is underappreciated?
I think that the UK really was an extreme case where we have seen how the trade-off in the policy might actually blow up and have dramatic consequences on the market. So it's really this a combination of fiscal and monetary policy at a time of very different target, because fiscal has to support the economic path, while central banks and monetary policy have to carve out inflation, to reduce inflation. So these two conflicting targets might really explode, as it has been the case in the UK. So hopefully this will be an insulated case, but definitely this is one of the risks we have on our radar.
How much does this really reduce how much borrowing there can be by governments and fiscal spending because of the bond vigilantes that have definitely spurred up?
Well, you really need to look at region by region, because, for example, in Europe, we have the other difficult task of fiscal solidarity, for example. So you have many countries that have to vote on unanimity in order to get a package, an energy package that can help the population. It is really not the same in the United States, where, if you want, there was more desynchronization between fiscal and monetary. Honestly, it has been only in China where the two in tandem have been working together. But really, apart the bond vigilantes, I think that top down we might have an issue of a policy trade-off and a mistake.
Monica Defend, thank you so much for taking the time. Truly wonderful. Have a wonderful weekend. Monica Defend there of Amundi. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. We did see some flip-flopping action ahead of the opening bell. We still see that flip-flopping action. The S&P now up about 0.5%. It just highlights the real uncertainty and concerns about liquidity and where the next shock is going to come from. Lack of conviction. This is Bloomberg. Time now for the trading diary, but before we get there, let's take a look at the flip and the flopping. Wow, it is flipping and it is flopping. The S&P now up 0.7%. Blinken, it might be down just as much. The NASDAQ up 0.4%. This comes as we see a retracement in the yields. They had been much higher. Now they're just a little higher on the long end. The short end, you're actually seeing yields come down. 10-year yields 4.26%. The 2-year yields 4.53%. This is the trading diary. What you need to be watching into next week. President Biden discussing the U.S. deficit at 11 a.m. Eastern. Looking ahead, U.S. PMIs on Monday, tech earnings ramping up with Alphabet and Microsoft on Tuesday, Meta and Twitter reporting on Wednesday, and finally, U.S. jobless claims and core PCE, followed by an ECB rate decision and Lagarde press conference on Thursday. One thing that is notably absent is Fed speak because it will be the quiet period starting on Monday. This was Countdown to the Open. This is Bloomberg.